If you or your spouse earns less than $40,000 a year, you could be missing out on a $540 tax break that many couples don't even know exists. This strategy is perfect for stay-at-home parents, part-time workers, and low-income earners. In this video, I'll break down what it is, how it works, why it's beneficial, and how to avoid common mistakes. Let's get started. This strategy is called the spouse contribution strategy. It's a government incentive designed to help couples boost their retirement savings while getting tax benefits today. Here is how it works. To get the full $540 tax offset, the receiving spouse must earn $37,000 or less, and the higher earning spouse must contribute at least $3,000 to their super. In return, the contributing spouse gets $540 on their tax return. If the receiving spouse earns between $37,000 and $40,000, the tax offset gradually reduces. In both cases, it's a win-win. The receiving spouse super balance grows, and the contributing spouse pays less tax. If the receiving spouse earns more than $40,000, the tax offset no longer applies, but the contribution can still help grow their super. Let's look at a real-life example. Before that, a quick disclaimer. This video is for educational purposes only and not financial advice. The example has been simplified to explain this strategy, but it's important to consider your entire financial situation before making any decisions. If you're unsure, please do further research or seek professional advice. Meet Tom and Sarah, a married couple planning for their financial future. Tom earns $200,000 a year, while Sarah works part-time and earns $30,000. With Sarah earning less than $37,000, Tom sees opportunity to reduce his tax bill while boosting Sarah's super. He decides to contribute $3,000 to her super fund. Because Sarah's income qualifies, Tom can now claim an 18% tax offset, $540 on his tax return. What does this mean in real terms? Sarah's super grows faster, helping to close the gap between the retirement savings. Tom effectively pays only $2,460 to add $3,000 to Sarah's super, thanks to the tax offset. They are maximizing tax benefits today while securing more wealth for the future. Now, what if Sarah earns a little more? If Sarah's income is between $37,000 and $40,000, say $38,000, the tax offset reduces. Here's how it's calculated. In this case, the offset applies to the lesser of the two amounts, $3,000 minus the amount Sarah earns over $37,000, or the actual amount Tom contributes. Therefore, the tax offset is calculated as $2,000 multiplied by 18%, which equals $360. This means that only the first $2,000 of Tom's contribution qualifies for the 18% tax offset. So if he contributes $2,000 instead of $3,000, he still gets the same $360 tax benefit. And if Sarah earns over $40,000, Tom won't qualify for any tax offset, but he can still contribute to help grow her super. However, at this income level, there may be other super contribution strategies that offer better tax benefits, so it's worth exploring all options before making a decision. There are 3 reasons why this strategy is worth considering. Who doesn't want to pay less tax? If your spouse qualifies, you are getting an instant 18% return on your investment to your spouse's future. Frankly, your joint future. And let's be real, no savings account or investment today is giving you an 18% guaranteed return with zero risk. One of the biggest issues with super these days is that women and lower income earners often retire with significantly less than their partners. Why? Because they take time off to raise children, work part-time, or simply earn less due to industry pay gap. By making spouse contribution, you are helping to close that gap. But this goes beyond the notion of sharing is caring. There is now a limit on how much super can be held tax-free in retirement, and many super strategies require a balance below a certain threshold to qualify. Additionally, there is an ongoing discussion about placing further caps on high superannuation balances, including potential taxes on unrealized capital gains. So instead of one partner having too much and getting taxed and the other having too little, this strategy helps even things out over time. It's future-proofing your finances, and the earlier you start, the bigger the impact. Super is invested, and the earlier you contribute, the longer that money has to compound and grow. Let's say you put in that $3,000 spouse contribution. Even if your partner is 30 years away from retirement, with a 7% average return, that $3,000 could grow to more than $22,000 by the time they retire. And that's just one contribution. Imagine if you did this for multiple years. That could mean an extra 6 figures in retirement savings. That's why this strategy isn't just about today's tax savings. It's about building wealth over time in one of the most tax-effective ways possible. This strategy is great, but only if done correctly. Here are some common mistakes people make and how to avoid them. Number 1, miscalculating the income. A big mistake people make is assuming the income limit is just salary or wages, but the ATO calculates it differently. The actual formula is the receiving spouse assessable income, excluding any assessable first home super saver release amount, plus reportable fringe benefits, plus reportable employer super contributions. If your main goal is to qualify for the tax offset, make sure you are comparing the correct income figure against the threshold. Plus, the income limits and tax offsets in this video are for FY25, but tax rules change over time. If you're watching this in a different financial year, be sure to double check the latest figures on the ATO's website before making a contribution. Another easy mistake is forgetting spouse contribution counts as non-concessional contribution for the receiving spouse. So make sure it doesn't push the receiving spouse non-concessional contributions over their cap for the relevant year. Additionally, the receiving spouse total super balance must be under 1.9 million as of 30th of June 2024 to be eligible for spouse contribution in FY25. Number 3, forgetting to check age requirements. The age and work status of the contributing spouse doesn't matter, and there is no work requirement for the receiving spouse either. However, the receiving spouse must be under 75 at the time of the contribution. This includes a period up to 28 days after the end of the month they turn 75. Only after-tax non-concessional contribution qualify for this strategy, so make sure no one claims this contribution as a tax deduction. Also, make sure the receiving spouse super fund classifies this contribution correctly as a spouse contribution, not a personal contribution. The key difference is who the contribution is from. A spouse contribution comes from the higher earning spouse, while a personal contribution is made by the account holder themselves. The spouse contribution strategy is relatively straightforward, but small mistakes can cost you the tax benefits. I put together a simple, plain English checklist if you find the ATO's website a bit hard to digest. The link is in the description box down below. Spouse contribution is just one of many ways to make super work better for your family. If you want more superannuation strategies, be sure to subscribe and check out my superannuation and retirement planning playlist. Thanks for watching. I'll see you in the next one.